Okay, investors, this week, first quarter earnings season and AI Capex cycle, we're going to update all the data from last week. We're going to combine a few stock talks into one episode. That leaves us right here. It's an AI Agentic Capex boom acceleration. So far, oil is up 50 to 75% since the Iran war began and the markets shook it off. Interest rates are running higher since the war began and inflation is running higher, but the market shook it off. And yes, the S&P 500 is hitting all-time highs. Both of these things were headwinds, but not roadblocks to the markets. Why? Because the S&P 500 earnings are booming, much like a previous CapEx cycle over 25 years ago. Yes, even earnings growth rates look familiar to the 1997-2000 Dotcom CapEx run. But investors, even if we are reliving the past, there would still be room to run because earnings matter more right now than the headwinds of higher oil or higher interest rates at these levels. With more companies reporting earnings, let's update last week's piece and go back to what really drives prices over time. Earnings and earnings growth rates. Not headlines, not geopolitics, not even the Federal Reserve most of the time. Once again, the data we're using is from FactSet Earnings Insight. They've updated their data, and here's the first chart on the 12-month forward S&P 500 earnings versus the S&P 500 price. Price follows earnings, and right now, reported earnings are accelerating sharply. We are now 2/3 of the way through earnings season, and the data just changed meaningfully, in a good way. It just stepped up functionally higher, meaningfully. First quarter earnings so far, a blowout. As of this filming, about 63% of companies have reported, 84% beating earnings, 81% beating revenue. Earnings surprise, 20.7%, which is the highest level since 2021, when we were exiting COVID lockdowns and expanding on massive fiscal and spending recovery. S&P 500 earnings growth now at 27.1% as far as earnings changes. Here's the historical year-to-year earnings growth rate the last 3 years. Bottom lines, investor, this is not slow, steady growth. This is a breakout earnings quarter. Where did the growth come from exactly? At the company level, the surprises reported by Alphabet, Amazon, and Meta were the largest contributors to the increase in earnings for the first quarter last week. Combined, these three companies accounted for a massive 71% of net dollar level increase in earnings of the S&P 500 in the first quarter. These are the largest companies in the world, beating revenue, beating earnings estimates, and accelerating growth rates. Alphabet by itself reported a positive earnings surprise 90% for the first quarter, compared to its 5-year average of 12.5%. Yes, some of that were one-time gains for their venture capital portfolio. Amazon reported a positive surprise above 70% for the first quarter, and Meta Platforms reported a positive earnings surprise at 56%. In the first quarter, record profit margins as well, new record highs. Net margins 14.7%, the highest ever recorded, up sharply from 13.2% in the fourth quarter, with tech nearing 30% margins and communication services like Google expanding fast. Probably because the big beautiful bill and its accelerated depreciation schedule for some of this expansion. Bottom line, earnings growth is being driven by both revenue and margin expansion. As far as looking forward, the outlook is high and still accelerating. For the second quarter, analysts are projecting earnings growth of 21.3% and revenue growth 11%. Third quarter, analysts projecting earnings growth at 23% and revenue growth 9.7%. Fourth quarter, analysts are projecting a little bit of a slowdown, 20.6%, and revenue growth 9.3%. For the whole year, analysts are projecting earnings growth at 20.6% and revenue 9.7%. Full year growth now 20% plus. Estimates rising, not falling. Bottom line, analysts are raising estimates very quickly, which is unusual this early in a quarter. So, investors, I have to curb your enthusiasm a bit now, looking out to those numbers to say way out in the fourth quarter of the year, after growth is supposed to peak in the third quarter. Many strategists are now saying that the current earnings growth rates and revisions are unprecedented. Unfortunately, they're not. Yes, they usually happen coming out of a recession. However, they have occurred during expansions as well. Once again, I'm going to take you way back in the Wayback Machine to the dot-com cycle in 97 through 2000. Here's a table of the year-to-year quarterly earnings growth rate for the later half of dot-com. Look at the table for a second and tell me the S&P 500 peaked during dot-com. You looked at those 26 and 22% year-to-year earnings growth rates in the second and third quarter 2000, it said sometime then, you would have been wrong. Because the S&P 500 peaked during Dotcom the last week in March 2000, right before earnings growth rate peaked at over 32.75%. You stuck around after that, you would have not been rewarded even though earnings growth grew at mid-20s, and that was against positive earnings comps. The good news, while the NASDAQ peaked and broke hard and fast in 2000, the S&P 500 meandered lower slowly for much of 2000 before succumbing lower in 2001. Once again, I'm bringing back the overlay of one of the most cyclical growth areas of the stock market. That area, semiconductor equipment manufacturing. These companies make the equipment that makes semi-chips we all use in everyday life, as well as the leading-edge semis used for AI training and inference being used in newer data centers. Here's that overlay once again, current AI cycle, first, Dotcom. Investors, having invested in technology for most of my career, including before, during, and after the dot-com run in 97 through 2000, I have never seen a semiconductor cycle end before orders and equipment companies accelerate for 3 to 4 quarters minimum. First quarter 26 was the first quarter we saw a pickup in orders, ex-China, and semi-equipment supply chain. It's tough to have a peak semi-cycle before additional capacity starts to ramp. At least that's my experience. For now, investors, stay focused on what matters: earnings, orders, revenue growth, margins. Keep your eyes on the prize. In this market, while higher oil has been a headwind and higher interest rates are another headwind, earnings are just as important. They are almost everything.